Now we get to talk about the coinsurance and insurance to value clause here. What happens here is that there is a situation in which some insureds decide that they don't want to keep the proper amount of insurance on the policy. So they're not keeping the replacement cost value amount there. So this allows for owners to reduce the amount that they are covering on the policy less than the replacement cost value. But what this does is it puts a line in the sand to where if you don't have the proper amount of insurance as determined by the coinsurance for the property, you will end up having to suffer a penalty on any partial losses on that property. So what we're talking about is, let's just say you've got a replacement cost value of $200,000 for a house. And the $200,000 is how much you should have on there so that if the thing completely burnt down, that you would be able to replace and rebuild that house. But the insurance company typically is going to put down a 80% coinsurance ratio on there, meaning that you're going to have to keep at least $160,000 of insurance on the property. Otherwise, any partial loss would be subject to this next formula that we're going to discuss. Now, to determine how much insurance you should have had on there, you just multiply the replacement cost value times the coinsurance. It's just a multiplication. 80% times the 200,000 gets you the 160,000. So the formula to reduce the payment in the case where the amount of insurance that you did keep on the policy is less than the amount that you should have, you would take the amount of insurance that you did keep on the policy divided by the amount of insurance that you should have kept on the policy, multiply that by the loss, and of course subtract out the deductible, and that would be the payment in the case of a partial loss where your amount of insurance was less than what you should have had on the policy. So an example that we have here is going to be John owning a home with a replacement cost of $100,000 for which he did insure it for $40,000 with a $1,000 deductible and an 80% coinsurance clause. He suffers a $40,000 loss. They're asking in this case, how much will he be paid? Well, of course, he can't be paid out $40,000, even though that is the maximum amount of insurance that he's got on there, because this is a partial loss and they will suffer a penalty in this case. So the first thing we do is we take the $100,000 times the 80% to create what we should have had on the insurance. So that we calculate the should first, and this comes out to $80,000. Now we take the $40,000 divided by the $80,000. We multiply that by the $40,000 loss and subtract out $1,000, which down will calculate out to $19,000 of payment to John in this loss situation. Second example here, just so you know, if there was a total loss on that case, $100,000 would be the loss, but the amount paid out would be the maximum that could be paid out. So a total loss would be up to the maximum, which would pay out to $40,000. Now, question 5, the insured purchased $100,000 of insurance on a building with a replacement cost of $250,000. The policy has a minimum coinsurance of 80% requirement and a $1,000 deductible. If the insured had a $120,000 loss, how much will the company pay? So this is not the proper amount of insurance, but we can figure that out real quick. How much insurance should this insured have had? You would take the $250,000 times the 80%, which comes out to $200,000. And clearly the $100,000 is not equal to $200,000, it's much less, and therefore you would take and apply the formula. So $100,000 divided by $200,000 for the did and the should, multiplied by the loss of $120,000 minus the $1,000 deductible. In this case, $59,000 is what it comes out to, and that's answer C.